Hello, everyone. Thank you so much for joining me today. And today we're going to be talking about one of the most confusing and sometimes risky areas that a lot of e-commerce, Shopify stores, and everybody else gets into, and that's capital and funding. Where do we get the money from? Many entrepreneurs feel so stuck between needing cash to grow and being scared to make the wrong financial move. It's just unbelievable. So let's start out with a quick Bible verse that kind of sets the scene for us. It's really offers some timeless wisdom. In Luke 14:28, it says, "Suppose one of you wants to build a tower. Won't you first sit down and estimate the cost to see if you have enough to complete it?" Now, this verse reminds us to count the cost before we commit. Let's apply that same wisdom to our funding decisions today. My name is Jacob Curtis. I am a CPA, a certified private first professional, and a business coach. And I started Curtis Accounting Solutions to remove the stress of doing the bookkeeping, payroll, and taxes, and to provide some practical business advice that helps Shopify stores and sellers piece together financial freedom. I'd love to hear your thoughts and questions on today's episode and topic, so please leave a comment below and remember to like, share, follow, subscribe, all those fun things. Okay, so before you seek funding, you got to ask yourself, do I really need it? For example, if your store is already profitable, but your cash is tied up in inventory, the issue may be that it just may be a cash flow timing thing, not a lack of capital. As another example, let's say that you want to hire a virtual assistant, but if your net income is $2,000 a month and your virtual assistant costs $500 a month, that might be manageable without external funding. So make sure you're actually solving the right problem. Let's look at some funding types that don't involve traditional debt. One of those is owner investment, which means you putting money you have in your savings in, but is a calculated risk, right? And the other one are revenue-based deals. Some ad agencies and others will accept this kind of arrangement. Well, they'll get paid for the sales growth. Strategic partnerships might also include some suppliers giving some longer-term payment terms and things like that. And there are grants for niche-specific things like women-owned, minority-owned, eco-conscious stores, veterans, all of those kind of things. There are some grants available. Now, grants are free money if you qualify for them. And so that's something to definitely look into. And not only that, a lot of local governments will also offer some type of grants to help things get started, whether that's city, county, or state. So remember, just kind of look for those grants. As an example, there was a client of mine who recently got a $5,000 local grant because their products were handmade and eco-friendly. So keep that in mind as you're looking for those things. There is a lot of free grant money available. Now, funding isn't always free. Even grant money, sometimes there are things tied back to it that maybe you don't have to repay the money, but there's always something you've got to be giving up. So even, again, those like grants and non-loan funding kind of costs are really there, like giving up control or paying out some profit, things like that. So you get $10,000 and owe back $12,000 in 12 months to whoever it is. That's a $2,000 cost. Now, if that $10,000 gets you $20,000 increase in profit, that's great. That's awesome. That's why you did that deal, right? But if it only brings in $11,000, you're actually worse off, because not only do you have to pay back $10,000, you have to pay back the additional $2,000, which is $12,000 you got to pay back. So you always want to be aware of the ROI and the cost of actual capital. While, yeah, you increase your sales, you didn't increase them good enough. So that's something to be very cognizant of when you go to borrow money or get more capital, more money, is to understand that ROI and how you're actually going to do that and fulfill your obligation to make sure you're making more than what you're going to owe back. So if you don't know your numbers, funding can really hurt and sink you. For example, if your profit margin is 20% and you take a $10,000 cash infusion, you need to generate $50,000 in revenue to net $10,000 in profit. And that's your break even, would be a $50,000 in new revenue on just a $10,000 cash infusion. And that doesn't include calculating in the interest that you may have to pay back on that $10,000, right? That's just your break-even point if your profit margin is only 20%. Have that forecast available. You want to know what money you're going to have to pay back. So make sure you can forecast out month after month, future months, where you're going to be in making sure that you can actually pay back that money and how fast you can do it. The other thing is you want to watch out for deals that sound too good to be true or come with some high pressure. So recently a client signed a funding deal with a 35% annual effective interest rate because it was marketed as super quick cash. And they did get super quick cash, but they paid $3,500 to borrow $10,000 in 1 year. So that quick cash actually hurt them quite a bit in the long run and over that course of that year. The pressure to say yes fast led to a very poor decision, and the need for that cash fast led to a poor decision. So if you don't understand the terms, walk away. Always ask, what if things don't go as planned? If I borrow $15,000 expecting to 2x that revenue and you only grow by 10%, will you still survive, right? Or do the numbers still work out if you don't meet that expectation? So use conservative numbers when you're doing your forecasting. Trust your gut. Remember, risk is part of owning a business, but blind risk is gambling, and that's what we don't want to do. We're not gamblers in the entrepreneurial sense. We do have some good guesses and things like that. We want to take on risk, but not blind risk. Remember that verse from Luke 14:28. Suppose one of you wants to build a tower. Won't you first sit down and estimate the cost to see if you have enough to complete it? That's what today was all about. We want to know how much it's going to cost to build your tower before you even start building your tower. Now, let's say you're in the middle, halfway through your tower, you've been in business for a few years. What do you do if you're running into cash flow problems? One of the easiest ways to get into cash flow problems is actually to borrow more money, even in the form of credit cards. Credit cards are a form of debt and borrowing money. So we want to make sure that you know your numbers, you take the time to sit down, count it all out, forecast, understand the risk, and so you can make a wise decision. This not only applies to funding, but again, also starting a business, launching a new product, maybe even starting a new marketing campaign. Take the time to sit down and really count out that cost to help you know your numbers and understand the risks. Make that decision wisely. And if you need help with any of that or have questions around funding or need assistance with managing your company's finances, don't hesitate to reach out to me. I'm here to help you guys piece together financial freedom. You can schedule a call with me by going to the QR code below, going to jacobcurtiscpa.com to book that call. And again, remember, follow me, Jacob Curtis, CPA, and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, and we'll talk to you soon.